Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing AT&T stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. AT&T is the world's largest telecommunications company and the second largest provider of mobile telephone services. The company is headquartered in Dallas, Texas, and was founded in 1983. It went public in '83 and trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, and many other stock exchanges. The company began its history as the American District Telegraph Company, formed in 1878. It became an independent entity in 1983 when the U.S. regulators forced the breakup of the Bell System monopoly. The company spun off its subsidiaries into several regional carriers. The company recently announced they will cut their dividend next year. The reason is because of the failed acquisition of Time Warner. It paid over $100 billion for Time Warner 3 years ago. It plans to sell that entity for $43 billion to Discovery. Just to name a few of the things Time Warner is made up of: HBO, CNN, and Warner Brothers. The $43 billion will be used to pay down debt, so they will save about $2 to $3 billion a year in interest payments. Overall, they lost a good amount of money with Time Warner, but the company admitted that and just wants to move forward. Let's get started with the model. This is a large cap company, 207 billion market cap. They're trading at $29 a share, and they have 7.1 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have a lot of free cash flow, from 23 up to $29 billion a year. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that is positive in 2018 and 19, negative in 2020 and the trailing 12 months. Revenue is the sales for the company. That peaked in 2019 at $181 billion. It's currently $173 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That's pretty consistent year to year, a little over $90 billion. Below that is operating expenses. Examples are marketing and depreciation. Then below that is operating income, which is around $25 billion a year. 2019 was their best year at $29 billion. Below that is the interest they pay in their debt, and that's around $8 billion a year. Then below that is other income and expenses, and these big negatives are due to asset impairments. And the bottom line of the income statement is their net income. They did have positive net income in 2018 and 19, negative in 2020 and the trailing 12 months. I would focus on operating income when I look at the income statement, because the reason they had negative net income was they had an $18 billion goodwill impairment. Goodwill is put onto the balance sheet when a company pays a premium above the acquisition price. If a company was worth $50 billion according to its balance sheet, and AT&T paid $60 billion, they would put $10 billion on their balance sheet as goodwill. In future years, they may write down the goodwill. That's called goodwill impairment. But this doesn't affect cash flow, as we'll see in a little bit. This is a breakdown of their revenue. The most revenue is, of course, from the telephone and communications, $139 billion. Then the revenue they're losing when they sell Warner Media is $30 billion. They also get $5.7 billion from Latin America. So even though they're losing $30 billion, they'll still have a ton of revenue, over $140 billion, much more than most companies. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. Because remember, in 2020 they had negative net income due to that large goodwill impairment. But goodwill is a non-cash item, so they still generated $43 billion of cash flow, even though they reported a $5 billion loss. That's why I like to focus on operating income. That's a much better indicator of the company's financial health than net income. And this company spends a lot of money in capital expenditures. This is investments in property, plant, and equipment. They need to spend a lot in CapEx due to the nature of the business. Operating cash flow minus CapEx gives you your free cash flow. And they have a ton of free cash flow each year. They pay about $15 billion of dividend payments, so half of it goes towards dividends. And they also use debt and equity to fund their business. They issued $700 million of capital stock in 2018 and repurchased $600 million, so they added about $140 million of capital stock. In 2019, they added $7 million. In 2020, they added $500 million. Every time a company issues capital stock, that increases the shares outstanding, making your shares less valuable. In 2018, they issued $47 billion of debt, paid down $56 billion. So they paid down almost $9 billion of debt that year. In 2019, they paid down about $13 billion, and in 2020, they paid down about $8 billion. Although in the trailing 12 months, they added about $14 billion of debt. Let's look at the capital structure. $165 billion of equity, $202 billion of debt. They're 45% equity, 55% debt. They will reduce their debt over $40 billion when they sell Time Warner. And their WACC is 7.6%, and that's a discount rate we're going to apply to the future cash flows. I actually calculated a WACC of 6.6%. I added 1% due to the greater risk of the company bringing in less revenue from Time Warner. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $457 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $419 billion. We divide that by 7.1 billion shares. And we get a calculated stock price of $59. They're trading at $29, so they're trading at a 51% discount. It's a really strong buy according to the model. Simply Wall Street is a lot higher than me. They're at $100 a share, so they're saying the stock is 71% undervalued. 15 analysts priced this stock, and the average price target was $32. The low was $24, the high was $36. What I'm doing is I'm valuing the company based off of their future expected cash flows. Pricing is different. Pricing is what you expect people to pay. So just because a company's worth $59 a share, apparently people aren't willing to pay that amount. Investors look towards the future of a company, and if they feel the future isn't going to be strong, they won't pay a high price today. But if they think the future will be really strong, they're willing to pay a premium for the stock. This is their stock price since it started trading. It looks like it peaked at about $60 a share. But you can see their stock price was in a pretty tight range between these two lines. That's why a lot of people invest in AT&T, because it's a pretty safe stock with a great dividend. You're not going to get these big declines down here, but the trade-off is you don't get the major stock appreciation up here. But people are willing to trade that safety for security. This is a stock price the last 12 months. So you can see it was up and down, but in a pretty tight range. This is when they announced they were going to sell Time Warner and cut their dividend. The stock price crashed. If it comes down a little more, I think you should jump in and buy a lot of this stock because it's definitely going to go up over time. This is a really big company that's been around a while. That's definitely not going away. They currently pay a great dividend, over 7%. To calculate the dividend, you can multiply their last dividend payment by 4, take that number and divide by the stock price. And they pay out 50% of their free cash flow. We can't look at their payout ratio because they had negative net income due to that large goodwill impairment. Their industry does pay a nice dividend, but they pay a dividend 1.5% above the industry average. AT&T didn't officially say they're cutting their dividend, but they did say they're going to pay out 40 to 43% of their free cash flow. Their free cash flow is projected to decrease at $20 billion in 2022 since they lose all the revenue from Time Warner. That's how I got the $20 billion up here. So 41.5% of $20 billion is $8.3 billion. They currently pay $15 billion. So their dividend is going to be a little more than half of what it is currently. So their dividend next year will probably be between 3.5% to 4%. In the mid-'80s, when the US government said AT&T was a monopoly, they forced them to break the company up into 2, 4, 6, 8 entities. And AT&T is right here, the one we're looking at. Subsequently, AT&T acquired the baby Bells. They acquired Bell South, Ameritech, Pacific Telesis, and Southwestern Bell. So the current AT&T is made up of these 5 entities. Bell Atlantic and NYNEX were predecessor companies to Verizon. US West merged with Quest.com, which merged with Lumen Technologies. Their stock is less volatile than the market. They have a beta of 0.74, so the stock moves less than the market. The stock has struggled the past 52 weeks, down 10%, while the S&P 500 is up 33%. Even with that nice dividend, this stock has really struggled relative to the S&P 500. The 52-week low was 26, the high was 34. And the stock is trading below its 50-day and 200-day moving average. This is a really liquid stock. 45 million shares are traded each day. Of the 7.14 billion shares outstanding, 7.13 billion are on float. When a share is on float, that means it's available for investors like me and you to purchase. A little over half the shares are held by institutions like hedge funds and mutual funds, and 1.7% of the shares are shorted. In the past year, 3 years, and 5 years, this stock has performed worse than its industry and the market. Analysts are forecasting their earnings to grow 2%, its industry 5%, and the market 15%. Analysts are forecasting their revenue to decrease 3%, its industry to be flat, and the market to increase 9%. I don't think these numbers took into account the sale of Time Warner, because their numbers are definitely going to be down next year. In the past 5 years, their annual earnings decreased 13%, its industry increased 22%, and the market increased 12%. In the past year, their earnings decreased 117%. That's due to the large goodwill impairment. Its industry increased 84% and the market increased 21%. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $17,000 today. That's a 5.3% annual return. The biggest shareholder is Vanguard at 8%. They're the largest provider of mutual funds. The second biggest is BlackRock. They're the largest asset manager in the world. Then State Street, that's the 4th largest asset manager in the world. Then Newport Trust with $34 billion of assets under management. Then Geode Capital, which was spun off from Fidelity Investments. Let's look at their financial ratios. The average PE in the market's 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. Their net income is the bottom line of their income statement. It's negative because of that large asset impairment. They have a really good price to sales ratio, 1.2, so investors are paying $1.20 for $1 revenue. That's much better than the market median and average. Their price to book is also really good at 1.3. And the way you calculate price to book is stock price over book value per share. And to calculate book value per share, that's equity over shares outstanding. Equity can be found on the balance sheet. It's total assets minus total liabilities. And they have $165 billion of equity, negative $131 billion of tangible equity, because they have $300 billion of intangible assets on their balance sheet. They got all these intangible assets from all the acquisitions they've done over the years. Their return on invested capital is 5.8%. That's their return on each dollar they invest into their business. And it cost them 7.6% to obtain financing. You generally want to see the ROIC greater than the WACC. I'm sure in previous years it was, but in the current year it isn't. They can cover their interest payments over 3 times. They have nearly $8 billion of interest payments. That's a lot of interest. They have negative net income, so negative ROE. And they can cover 80% of their current liabilities with their current assets. And their current assets are $11 billion of cash, $17 billion of receivables, and $31 billion of prepaid assets. Prepaid assets is when you pay for a good or service before you receive it. Like if you pay for your rent 6 months in advance, you carry that as an asset on your balance sheet, but each month when the rent becomes due, you remove that dollar amount off your balance sheet and pass it on to the income statement as an expense. They generated $29 billion of free cash flow in the trailing 12 months. Their working capital is negative $14 billion. Working capital is current assets minus current liabilities. And they paid $15 billion of dividend payments. That will be cut down dramatically next year. So they have $744 million of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 11 companies in the same industry as AT&T, and if AT&T has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They have negative PE, so we can't look at that. They have a really great price to sales and price to book ratio. They're worse than average and current ratio. They have a negative ROE. They're pretty close to the average in debt. And after Verizon, they're the biggest company on this list. And they pay an amazing dividend, over 7%. So to summarize, I have them trading at a 51% discount. And this company has always put up great numbers. A lot of people who are retired invest in AT&T for that dividend payment. And also the safety of the stock. I know a lot of people are concerned that they're cutting their dividend, but I'm sure they're going to bring it back to where it was at some point in the future. Plus, this is such a big company. Even though they're losing a chunk of their revenue and free cash flow, they're still a monster company. So if the stock price comes down anymore, I think it's a great value and it's a great long-term hold. I rank their free cash flows 9 out of 10, their revenue 8 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.